Hello friends, welcome. My name is Kalidas. I'm a company secretary. Today we will discuss the characteristics of PPF and ELSS scheme. Basically, sometimes what happens is that people tend to ask which scheme is better, whether I should invest in PPF or I should invest in ELSS for tax saving purpose. So before concluding, let us look at the characteristics of each scheme and whether that scheme is a saving scheme or an investment scheme, because that distinction is very important for long-term wealth creation. So first we will deal with PPF. PPF means Public Provident Fund. So this scheme is administered by the government through, this is a basically government scheme, so 100% safe. Today's interest rate is 7.1%. It is totally tax free. So it is 100% safe as well as secured and with reasonably good interest income. You can open that account in quite a few nationalized banks as well as in post offices, depending on the quality of the service you choose, and wherever you are comfortable, you can choose any of these banks or post offices. The scheme is once you open the account, you cannot close it for a period of 15 years. So from liquidity point of view, there is some concern because your money is locked for a period of 15 long years. Of course, there is a scope for taking a loan in the initial years, and after completion of 6 years, you may withdraw partially, but nonetheless, from liquidity point of view, there is still some concern is there as such. Since this is a scheme of 15 years, obviously the compounding effect is really good, no doubt about it. But whether it is substantially good or not is basically a relative concept, because the rate of return is fixed. The government fixes this rate every quarter in advance. Like for example, from October to December quarter, they have recently fixed this rate at they have maintained rather at 7.1%. But there is a possibility that over a period of time the rates may come down. I'll tell you one why I am thinking that way. Because recently there was a news in the media that the government has slashed the rate of interest on this scheme by 0.90%. And next day, because of some opposition or something like that, they withdrew that proposal. I mean that notification they have withdrawn. I feel this is a signal, because see the interest what the government pays on PPF actually comes from their pocket, that is from the tax receipts what the government gets, and naturally the government is very much concerned for reducing their expenditure. So from that angle there must be some thinking going on in the finance ministry to how to reduce our expenses so that the money is available for development schemes. So in English we say there is no smoke without fire. So there must be some thinking going on in the government circles that we should reduce this rate of interest, and probably this notification was issued, but maybe because of some reason, let us not go into that, maybe some political convenience, or maybe the timing may be wrong, something like that. So they withdrew this proposal, but that does not mean that the 7.1% interest will continue for next 15 years or for whatever period it is. You can renew this account after the first initial period of 15 years. When it gets matured, you have the option of renewing this account for a period of 5 years every time for a number of times. So this is you have to deposit minimum 500 rupees in this account, and the maximum limit of deposit is 1,50,000. So even if suppose if you want to invest say 2 lakh rupees in this account in a financial year, it is not allowed. The maximum cap is 1,50,000. So this you must remember, because sometimes you may feel that 7.51% is very good rate of return which is tax free, or I'll invest my 10 lakhs also. No, only 1,50,000 is allowed in this. So this is account. Savings or maybe so this is quasi investment. Finally, it is a deposit in a bank or maybe in the post office. So this is as far as PPF is concerned. Now let us move to ELSS. This is nothing but a mutual fund scheme with tax benefit. So most of these mutual funds, they have come out with their own tax saving scheme. Apart from SEBI, which is the regulator for mutual funds, there are guidelines issued by Ministry of Finance also, which need to be adhered to by these mutual funds in respect of these particular schemes. Here you get tax benefit just like PPF. The maximum cap of tax benefit is 1.5 lakh. But if you are convinced that yes, a particular ELSS scheme is very good and I have got liquidity, so I should put in that more money also, it is allowed there. Suppose you have got say 3 lakhs, you can straight away put 3 lakh in that scheme. The only difference is that out of that 1.5 lakh will be qualified for tax benefit purpose, but nonetheless you will continue to get the benefit of compounding over a long period of time on that 3 lakh rupees. Every year there is no need to deposit any amount, but if you are going for a SIP, systematic investment plan, in that case each your systematic investment installment will be locked in for 3 years. Now when I said 3 years lock in, that means you will not be allowed to redeem those units. But that does not mean that the scheme gets matured in 3 years. Please understand this. Sometimes there is a confusion that after 3 years we feel that it is matured, so in a hurry we try to redeem those units. But suppose if that time the market is down, in that case you may tend to either lose your principal or in some cases at least your returns may be low. So there is absolutely no need to redeem the units after a lock-in of 3 years. Let it grow for a longer period of time. You also have the option to put in any amount of money in this same scheme over a period of time, any number of times, and it will continue to grow as per the share market. Why I am saying this is that finally what is share market? The company shares are listed. The companies will continue to try to grow their business. Once their business grow, naturally the profit will also grow, and eventually it will reflect in their share price. So it will reflect in the performance of your fund also. So that way you can do it. Secondly, what happens is that suppose if you have got a better mutual fund scheme in some other scheme you want to invest. So what you can do, for 3 years you choose one ELSS fund. Then from 4th year onwards, you can redeem the investment in the first year, say 1.5 lakh. In redemption, of course, there will be tax angle which you will have to look at. But that amount again you can invest in the 4th year and get the tax benefit. If in some cases what happens is that your scheme is good, you continue to deposit every year, well and good, because it will help you in building up a very good corpus as such. But in some years, suppose if there is a liquidity or cash flow issue, that time you can use this trick. Suppose if you are a young person, then this could be a very good tool for building up a retirement corpus. Because what happens is that you have got a more number of years at your disposal for investment, and then at the time of retirement, you can withdraw some amount like redemption. It is called as redemption, of course. By way of SWP, systematic withdrawal plan. There will be a separate video on SWP which can be used as a retirement tool, and then that you can start getting monthly sort of income sort of thing. So that way ELSS is an investment, PPF is saving. You need to choose between the two wisely as per your requirement and as per your safety or your risk taking ability, I can say. So if you like this video, please press the like button. Please subscribe this channel and also share this video so that other people also can get the benefit of this information. Thank you very much. Goodbye. Sri Ram.